Okay, so welcome back to this session. This is just in case I upload this video as a two-part video instead of just one. So we left off at loan amortization, and it was just a way for us to be able to see um, how the loan is paid over the period of time from when it was taken, breaks down the payment numbers, the payments. We are able to see the principal and as well as the interest for each payment and eventually the balance. And I told you this is a strategy that can be very effective, whether you're paying for a mortgage or you're paying back a bank loan. This is something that you can be able to do in your free time. So I tried to autofill the remaining part of the schedule, but it wasn't able to cooperate. So I went ahead and just did for each and every cell. So the whole goal is to create a schedule until the total balance is zero. So remember that we calculate from the first payment and you can see our payment numbers, and you can see for this loan we will have 24 payments, and then we are able to see the payment for each, and the interest, I mean the principal, that is the principal that is paid towards the loan, and eventually we are able to see the interest for each period, and then the balance that remains as you continue to pay the loan. So that's basically the loan amortization. Remember to get the payment, to use the PMT function where we put in the annual interest rate. So remember, we are calculating monthly. We are seeing monthly. How much are you going to pay? How much principal are you getting paid as you pay monthly? And the interest that is covered monthly and the balance that remains monthly. So the years that you expected to pay this loan is 2 years. It's annually, the interest rate is 5%, and then the payment per year is 12, meaning that you're paying monthly, and then the amount is 20,000. That's the amount you took or borrowed for the loan. So to get in the payment, we use the PMT function where we use the annual interest rate. We divide it by 12 to get the interest monthly, and then we multiply the years by 12 to just get it on a monthly basis, and then we use the amount. For the principal, we use the PPMT, where we divide the annual interest rate by the payment per year, and then we get the payment. So the second, let me just click on it so that you can be able to see it well. The second argument is the payment, that is one, and then we have B2, which is the years multiplied by 12 to get it in a monthly basis. And then we now have our amount finally. For the interest, we use the IPMT, where we get, of course, we multiply the annual interest rate by the months, that is the payment per year, to get it on a monthly basis. We get the second argument being the payment number, and then we multiply the years by the payments per year to just make it on a monthly basis, and the amount finally. And then we say the balance, we just add the amount plus the principal. The principal, as you can see, is in red and is in brackets. In accounting, that automatically shows that it's a negative. So in accounting, we don't go ahead and keep writing the negative sign. We just put it in brackets, and it automatically knows that that is supposed to be a negative value. Okay, so that's our amortization schedule, which we are able to see the payment numbers, you're able to see the amounts that you will pay, and how much goes to the principal, how much goes to the interest, and the balance after that payment has been made. So it is able to give us a clear view, and this is something that is very important, not just for the bank or for the organization that is lending the money, but for you as a person paying the money. You're able to see, is this really making sense as an investment? A loan can easily be an investment depending on how you take it, how you use it, and how you pay it. So it is going to be an investment or a liability on my end. Okay, so we have a few other things I want us to cover before we call this the end of the finance session. We have the NPV. We will also look at the IRR, the depreciation, where the IRR is just the internal rate of return, and then the NPV is the net present value, and then we look at the depreciation and the different ways to calculate depreciation, and then finally the profit margin. So we don't have much remaining. We have done the most, but also what is remaining is important. So we will get okay. So our question as we start with the NPV. Now I'm getting into the NPV. Is So remember, NPV is used to calculate the present value of a series of future cash flows and subtracts the initial investment. So you just get the net present value, okay? The present value of now. So for example, Project X requires an initial investment of $100. So I can come ahead. Okay, we expect a profit of $0 at the end of the first period, a profit of $50 at the end of the second period, and a profit of $150 at the end of the third period. So, for example, so this is just a way to gauge your investment. So, for example, if we have okay, if we have the discount rate at 15%, and you're told that the first period, okay, now this is when you're investing the money in the business. So we are assuming that you're investing, you can say negative, you can write it as negative 100 or in brackets 100. It's still going to be okay. 1 0. So why do we say this? It's because we assume that for the first, okay, this is the zero, like zero is today, is when you start investing. So according to the period, maybe you're doing this monthly or yearly or quarterly, you can now go ahead and say that the second quarter, in case you're doing it quarterly, okay, so the first quarter is what you invest, and then now the second quarter, or okay, the first quarter is okay, once you give out your payment, the first quarter is now the one which we assume is going to be a zero. Why? You're assuming that the company is, or the investment is still first repaying the $100 that you invested. So the cash flow is like it has gotten to a point where we say it has, I've forgotten that word. I've forgotten that programming term, but I mean that accounting term. But breaks, yes, breaks even. It's when it breaks even. So after that, breaks even is that you have received your initial investment. So after that, now you start calculating the investments that the company brings or the investment brings. So we're going to just assume that that's how it is working. So we have that. I'm sorry for that. Okay. So now we want to calculate the NPV of the current project X. So we're going to come ahead and just type, first here I will just type NPV, and then I'll come ahead and now use the NPV formula. It's already there. And you can see it gives us an explanation, returns the net present value of an investment based on the discount rate and a series of future payments, negative values, and income positive values. So you can see your payments or your investments are negative values and your income is the positive value. So based on our discount rate. So we are going to go ahead and first input. You can see it actually gives you what you should do. Put in the rates, that is the discount rate. So in my case, that's B2, comma, now my values. So for my values, because I wanted to show the range where it's from, we are going now to first start with the positive values, then end with the negative value. Okay, so I'm just going to start from B6 because that's where my first positive value is, which doesn't have a negative. So from B6 up to, wait, what's happening? Okay, from B6 up to B8, right? And then close my bracket and then now say plus B5, plus B5. Yes. Um, should not be, it should have a decimal point. Let me just confirm. B2 plus B5, okay. Okay, I have realized the issue. Um, let's give this a currency. Let's see if that will change how that is. I want the NPV to have a decimal value. Okay. Oh, yeah, it's still okay. I've actually realized it's still okay, it being the way it is, because if it is a percentage, we will, it because it's in percentage, for you to get the other value, you will just have to divide it by 100. You will just have to divide it by 100 to get it being $36.43. That is what I expect it to have, but it's okay even showing as a percentage. So that if you just want it in the currency, you can just call it or say that it's $36.43. So this is the rate of return of the best alternative investment. That is if you input your money where the account has, or where the investment gives you a discount rate or an interest rate of 15%. That's how much money you will be able to have. That will be your net present value. So a positive net present value, like in our case, indicates that the project rate of return exceeds the discount rates. In other words, it is better to invest your money in project X than to put your money in a high yielding saving account that has an interest rate of 15%. So that is very it's it helps you to be able to know. Sometimes you get projects where they tell you, okay, so this is our interest rate when you invest, or some like MMFs, or just other forms of investment, and they tell you, so this is our interest rate. And then probably you go to the bank and you find that probably they have the same interest rate, or maybe slightly lower or slightly higher. So you can be able to calculate, okay, so which one outweighs which one. If I invest in this, how what is will be the net present value as compared to the saving account. And when you get it as a positive, you know that it is actually better to put your money there than to put your money in a savings account. So let us change things up and look at just as another example of this. So I will just call this project Y. Okay. I will also now have the discount rate, and then I will now have the period and the cash flow. So let me just add on this just to increase the width so that it looks reasonable with the discount rate. And then now we'll have our period 0, 1, okay, 1, 2, 3 as well. So for this, we will also still have a discount rate of 15%. And then we can now have our first cash flow being the investment that you put in. So, and then the next in cash flow being 150, and then the next cash flow being 50, and then finally it being 0. Okay, so notice for this that the cash flow went on increasing, and for this the cash flow goes on decreasing. I haven't input 0. Yeah. Okay, so we are finding the NPV for this. So I will just go ahead, sorry, I'll just go ahead and say NPV NPV have my rate, which is E2, sorry, E2, and then I just prefer using everything in caps just to be clear. And then we will now have our duration. So we are going to start, of course, you're not going to input the first investment. You're calculating if this investment is worth it depending on the cash flow. So you're not going to add in what you invested as the investor. You're going to calculate what you are receiving as the investor. So I'm going to start with E E6 up to E8, and then now plus our E5. So if we run that, we can see we are getting 68.25. So the net present value of project Y is higher than the net present value of project X, meaning that project Y is a better investment, So something that I have noticed probably, let's try and remove. Okay, let us just leave it as is. So remember this, to turn it into the investment, you just divide by 100, making it $36.43. This is directly given us, and I think I have realized why. So it's 68.84. So we see that this net present value is higher than this, meaning that project Y is a better investment than project X. So this is a good way, especially for, when you get friends who are telling you invest in this, this is what you receive, or this is what I have received, and somebody else comes and tells you invest in this, so you can be able to easily calculate if that is going to be a worthy investment. So the NPV, just like I have said, just calculates the present value of a series of future cash flows. And we have seen how that has been done. So I don't know, we can do a few more examples on that just to drive the point home. So we can have another project A. Project A. So, okay, just next project A. Let me just increase this workbook's font size just to make sure everything can be seen clearly. Yeah, project A, discount rate. And then we'll now have our period and our cash flow. So let me just increase that width. Okay, so our first period is going to be 0, 1, 2, 3. And then now we'll have the NPV here. And then now our cash flow. So our cash flow is still going to be $100, our initial investment. So let us now get our cash flow. So for this scenario, we get no cash flows for the first two periods, and then in the last period we get 152.09. Okay, so what is the NPV for this period? What is the NPV? So I'll just go ahead and type that. Okay, thank. So we are, oh, the discount rate is still the same, 15%. Wait, okay, 15%. So our H2, our cash flow period is from B6 up to B8. Okay, it's in small, but it's going to leave it like, okay, I don't think it has been, no, it's H6, sorry, H6 up to H8. Yeah, plus now our initial investment, which is H5. So yeah, so we can say the NPV for this is $0. So this indicates that the project generates a rate of return equal to the discount rate. Other words, both options of investing your money in project A or putting your money in a high yielding saving account at an interest rate of 15% yield an equal return. So yeah. So you can actually just confirm this by using confirming that you get 152 when you put it in an bank account by just coming ahead and say assume I put let me just put it here. So we'll say 100%, and then you come and say assume you put the $100 into a bank. How much will your investment be worth after 3 years at an annual interest rate of 15%? Of 15%. So you just come ahead now, say in this, say is equals to A1, not A1, sorry, G13, no, G12 multiplied by 1.15 over 3 years. So you can see you get the 152 points. So it's the same thing if you invest in project A or if you just put your money in the account. So you see, we are able to see how this works for us. Is this something that we can do, we can work with, or it doesn't really give us an investment value? So I don't know. Do I think I can do a few more? Yeah. So we shall look into this more about the internal rate of return in the next topic. You can see IRR. So let us not bother you that much. So let us move ahead. So project B, discount rate, discount rate, and then period, and then cash flow, and then 0, 1, 2, 3. And then now we have the NPV. So we have 100. Yeah. So the first cash flow can be 25, the second can be 50, and the third one can be 152.09, what we had before. So what is the NPV for this? So you just say is equals NPV. Okay, still 15%. Is equals to K2, comma from K6 up to K8, close bracket, plus plus K5. So wait a minute. 152, 50, 25 minus 100. Let me just confirm how I have. Okay, let me first put this into bracket $100 so that we just get it in K2, K6, K8. Yeah. Yeah, so it becomes 59.55. So it gives us a positive NPV. Um, so to confirm this, we can check the present value of each cash flow next we sum up this value. So just a long way of doing this is now coming up here and just putting PV, that is present value, and then okay, let's just show the formula. Okay, so for the first, we'll just leave it as is since that's when you're investing. So we are going to do this is equals to, now to get the present value for that is going to be B6, no, for our case is K6 divided by 1.15, 1.15, and you can see that is the value we get, 21.73. And then we can now go ahead and for this we'll just do the same. K7 divided by 1.15. So that is, no, this is supposed to be K7 raised to power 2 since it's the second period. Remember how we did this for the third period? We raised it to power 3, so that is what we should do. And then now we come ahead and do for the second part, which is going to be K8 divided by 1.15 raised, okay, raised to power 3, giving us 100.00. So with that, to get just now the total value for all of that, you can now sum. You can now sum. So it will just be is equals to sum to get the total NPV value. So it's going to be sum from L from L okay from L6 up to L8. Yeah. So if you do that, you can see that you get 159.548. So your investment over time has grown to 159 with a net present value of 59.55. So project B is a good investment as well. It's a good investment as well. So sometimes if you just want to get the direct value here without having to get just the 59, you can just do it, just get you'll get directly 159.55 without you just getting the only the value itself. You can get the total NPV value. Okay. So with that being said, I feel like we have been able to look at everything that we can on NPV, and in case of any questions, you can just ask in the comment section, or you can just type on the WhatsApp group for those who are in the WhatsApp group. Okay, so let us move to IRR. IRR, which is used to calculate the project internal rate of return. The internal rate of return is the discount rate that makes the net present value equals to 0. So it makes the net present value equals to 0, and that is something we saw in this example in our project A, in our project Y, where No, actually, sorry, it's in our project A, where our net present value was 0.00. So that is something that is what is the internal rate of return basically does. So it is the discount rate that makes the net present value equals to 0. So for example, we have a project A with a discount rate. Sorry, we have a project A with an initial investment of $100. Sorry, $100. So I'll just come ahead and write my $100. My $100, and then let me just add the periods. So we expect the profit at 0 um, at the end of the first period. Yeah, so of course here, like I said, in the first period, we just expect it to be okay. At the first period, it was 0, and at the first period, the profit to be, and the profit at the second period to be 0, and the profit at the third period too. So this is information that you're going to be given. So the only thing you're going to do is calculate the discount rate. So you're already told that this is the profit that is going to be received in this period and in this period. So you're just able to know that. Yeah. So I don't need to actually put in the dollar sign. I wanted to give. Yeah. So let us calculate the discount rate. How do we do that? How do we do that? So first we will get the NPV. We will get the NPV. No, we really don't need the NPV for this since we don't even have the IRR. So how do we first find the IRR? Yeah. So the IRR is calculated by using the formula IRR. So you can see it says returns the internal rate of return for a series of cash flow, and then the values. So my values is from B5 up to from B5 up to B8 up to B8. Yeah, so with that, I can be able to see that my IRR is 15%. I can be able to see that the IRR is 15%. So this IRR will make the NPV. So if I put here my discount rate to be 15%, sorry, 15%, I can now come ahead and say NPV is equals to NPV into um remember our discount rate, so B2, or you can just leave it at the bottom at B10 so it doesn't make a difference. B2, the cash flows, that is from B6 up to B8, close my bracket, plus B5, my initial investment. So with that, you can see now the NPV is 0.00. So yeah, you can see that has worked perfectly. So the net present value of zero indicates that the projects generate a rate of return equal to the discount rate. In other words, both options of investing your money in project A and putting your money in a high yielding saving account at an interest rate of 15% yield the same return. And that is something we were able to see with this example here. Yeah, we calculated this amount by this interest rate for 3 periods and we got 152, which is what we have received here. So, yes. We can do one more example and just see more of this. We can do one more example to see more into this. So we have a project B. Project B, which has a discount rate a discount rate and then let us now put in the period and the cash flow. So the first period of course will be 0. So let us have 3 more. Okay. And then our initial, okay, so according to the question, a project B requires an initial investment of $100. $100. We expect a profit of 25 at the end of the first period, a profit of 50 at the end of the second period, and a profit of 152.09 at the end of the third period. So the IRR function below calculates the okay. So let us calculate the IRR function. So just use the IRR formula. So it's just going to be from B5 up to B8. Up to E8. Okay, so it's 39%. So if we use that directly to just get the NPV, of course, since the internal rate of return is just used to make the NPV 0. So automatically we know the NPV is going to be 0 based on that IRR. So you can just go ahead. So you can go ahead and just input here. Okay. You can just go ahead and input here 39%. And then we now come ahead here and now input our NPV into E2, comma from E6 up to E8 plus E5, and we get that as 0. No, it's 0.50, but let me see if there's something I have done wrong. If there's none, we'll just take it like that's the calculation. So I guess it's just rounding off or punctuation errors. So we get 0.50. So yeah, that is that. So we have what we call the IRR rule, which states that if an IRR is greater than the required rate of return, you should expect you should accept the project. IRR values are frequently used to compare investments. So, for example, if you had, initially we can be told that this project has a discount rate of 10%. From initial, you can just be told that the project has a 10% from the get-go. And then now once you calculate your IRR, you find that it is 39%. So if the IRR is greater than the required rate of return, you accept that project. Okay, so that's just basically it. So because the higher IRR indicates a better investment, and even you can compare. Okay, let me scrub off that explanation of comparing the discount rate with this. Compare two IRRs. So for this case, project B is a better investment than project A because the IRR is higher, okay, than the one for project project A. Project B is better than project A. So, and also if just and also if when you're just given one project, you don't have another comparison project to look at, if the IRR is greater than the required rate of return, it's still a better investment. So I hope that is understandable. So also something else you should note is that look at also the cash flows. Don't just assume that because the IRR is greater, the cash flow is better. No, look at the cash flows. Let me do an example to expound more on that. For example, let us have projects. We are going to have three projects. Project X, okay, and then we'll have the discount rate. And then we will now come ahead and have the period, and then we will have the cash flow. Okay, and then yeah, so 0, 1, 2, 3 periods, and then this cash flow also starts at -100, meaning your initial investment to okay, let me just put it in dollars to be on the safe side. And then the second cash flow is going to be 0. The third is going to be 50. Yeah, and the fourth is not going to be 150. No, the third cash flow, but the other one was just the investment. And then Yeah, we shall have here the IRR, and below it we shall have the NPV. So let me just also just write the next project and just have it. Project Y, discount rate, and then now have the period and the cash flow. So 0, 1, 2, 3. So the cash flow for this project is, of course, the initial investment of $100 as well. And then, of course, when you're comparing several projects, you really want to compare. If I input the same amount in this project and I input the same amount in this project, now that is not a comparison. You won't assume that you're putting in different initial investments in each project. So that's why we're using the same initial investment. So let us have now another project Z. Discount rate, and then we'll have our period, and then we will have our cash flow. So this starts from 0, 1, 2, 3, and then that being okay. We have changed. Let us change the initial investment in this. Team 5 and 0. So this will show us just what I mean by the different cash flows. Just see that in the conclusion. So to be IRR, NPV, IRR, NPV. Okay, so let us do this. So in case for our project X, we want to just see, we want to calculate the internal rate. So we will assume that the required rate for this project is 15%. Okay. So let us first calculate the internal rate of return. So is equals to IRR. Okay. Is equals to IRR into brackets from H5 up to H8. So we get that as 29%. Of course, the NPV is going to be 0, 0. Okay, so this changed because of this value. So we can just change our formula. I've just noticed that. So let me just change it. Here it should be E, because you're comparing using the internal rate of return. So let me just make sure that that is fine. Okay, so for this as well, I'll just go ahead and say to get the NPV. Okay, though we already know the NPV shall be 0, I don't think we need to calculate that or focus on that. Let us calculate the internal rate of return for this, for project Y. So it shall just be the same. IRR from K5 up to K8. So you can see that is 75%. I will also do the same for this IRR from N5 up to N. Wait, I missed out one value here. Okay, let me just put it and then it will adjust up to N8. N8? Yeah. So let me just make sure this value is inputted. 5. So yeah, it has changed to 122. Okay, so remember the rule, the IRR rule, which states that the IRR is greater, okay, that if the IRR is greater than the required rate of return, you should accept the project. So for this case, our project had a rate of return of 15% and the IRR ended up being 29%. So it just basically says you should just accept that project. And then we also noted that if you have two projects which you're comparing the IRR, the one which has a higher IRR is a better investment, with our case being 78 and 29. So we are advised to pick project Y with comparison to project X. But also when we come into project Z, we see it has a high IRR of 122. But we note that the cash flows are lower as compared to project Y, right? So that means project Y is still a better investment than project Z. So as much as you are comparing the IRR, it's very important that you also look at the cash flow. The cash flow. So that's basically it on IRR. So let me move on to depreciation. Depreciation. So depreciation is going to be a little bit longer, so just be prepared for that. But the goal is understanding. The whole goal is just understanding how that is going to be achieved. Okay, so let us do this. So in depreciation, it's just calculating how an asset is depreciating over time. How an asset is depreciating over time. We are going to consider an asset with an initial cost of $10,000. So just here, I'm just going to write $10,000. And then it has a salvage value or a residual value of $1,000. And then a useful life of 10 years. Of 10 years. So this just basically says that after the 10 years, it would be worth $1,000. Okay. So we are going to look at these are different functions that are used to calculate depreciation. So we're going to look at all of them. Okay. So so of course we all know that most assets are useful in the beginning of their lifetime. Well, except for something like land. Land goes on appreciating, it does not depreciate. But for something like a car, the newer it is, or in the beginning of its lifetime, probably in the first 2 years, it has a higher value as compared if that car goes over 5 years, or yeah, over 5 years. So we are going to use first a formula known as the straight line. And in Excel, through the straight line, we assume that each year the depreciation value is the same. The depreciation value is the same. So the straight line is what we have as SLN. Let me just increase the font of this worksheet. So I believe that's better. So the period, the first period, to get the straight line value, you just say is equals to SLN into um, cost. So remember we have our cost here. Yeah. So you can even see it gives you cost, salvage value, and life. So cost is $100. So that is going to be B1, comma the salvage, which is B2. So this is pretty straightforward. B2, and then the life itself, that is B3. That is 900 dollars. So just that's just basically it. That's just how they take it as, and this can just be done by subtracting, by saying cost minus salvage value over the 10 years, and you're going to get 900. So over the period of 10 years, it's just going to be it's just going to be 900. Okay, so that is that. We are now going to look at something we call sum of year digits. So it's also an easy formula, sum of year digits. That is what we have at the SYD. So we just come ahead to say SYD into now the cost is going to be B1, comma the salvage, which is B2, comma the life, which is going to be, and you can even see it tells you, yeah, the life, which is going to be B3, comma now the par. So par in our case is just going to be the period. Okay, so it will be, sorry for those who are not Swahili. I've just talked in Swahili a little bit. So it will just be now A A8, right? That is our period. So if you just input that, let me just increase the value for this. Oh, that's a lot. That width is a lot. Okay, just increase it. Yeah. So let me just also increase the beforehand. Yeah, so we can see that that's the depreciation using the sum year of digits. So the sum year of digits performs the following calculations, okay? So a useful life of 10 years results to the sum of the years. So you'll go from 10 plus 9 plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1, giving us 55. So the asset loses 9,000 in value. Depreciation value period is 1 over 1 is equals to 10 over 55 times 900, 9,000, making it 166.36, what we have here. Okay. So like for the second depreciation, like if you are doing this using the second formula, okay. So, okay, so this is just going to be B1, B2, B3. Yeah. So for this, it's now going to be is equals to SYD into, just to see the difference, SYD into our cost, where it's B1, the salvage, which is B2, um, the life, which is B3, and the par, which is now going to be A9. So if I close that, you can see what the value is. Now I expect this value to change. There's something that I have not done. Oh, this should not be 2. This should be 2. The period should be 2, not 1. So yeah, you can see now the value changes. Okay. So basically what is happening, just to give this explanation once again in case you did not get it when I said it, for SYD, since there are 10 useful life, it will be now 10 plus 9. Let me just put an is equal so that it does it for me. 10 plus 9 plus 8 plus 7 plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. And you can see now that totals up to 55. So since the asset loses 9,000 in value, and that is calculated by dividing the cost minus the salvage, you can see that the asset will lose $9,000 in value. You will now, to get for the first period, we assume that you calculate 10, let me just put it, 10 divided by 55, all that, let me just put that in brackets just to make sure that it does this correctly. All that into the 9,000. So you can see you get this value. So for the second value now, it's going to be 9 over 55. Got to do that in brackets. Brackets. Yeah, times the depreciation, which is 9,000. And you get 147.472. So that's just what has happened. Okay, so to get for all those periods, for the 10 periods, you are going to have to keep on doing that till the end. Okay, and then now we'll have what we call DB, which is known as the declining balance. So to do for the declining balance, it uses the fixed rate to calculate the depreciation values. So how do we do that? You come ahead and say is equals to dB into the cost, which is going to be B1, okay, and then the salvage, which is going to be B2, and then the life, which is going to be B3, and then our period, which is now going to be A8 for our case. A8, okay. So that is for declining balance. So let us do for the second one, and then I will explain what is happening. Is equals to dB into the cost, which is B1, comma, B2, comma, sorry, B2, comma, B3, comma, now our A9. Okay, our A9. So you can see now that is 1,600, and you can see that's a little bit different. So what is really happening with the DB? So the DB does this. I'll explain it on this cell, on this column. So it sets the fixed rate, and then it says 1 minus, I think I can, okay, it basically does 1 minus salvage cost, okay, divided by the cost, and then all that raised to 1 over the life. So what is really happening? What I'm saying is you will have is equals to, let us just calculate the first one directly now. 1 minus salvage cost. So what is our salvage cost? First, I'll put this in brackets. Our salvage cost is 10,000. 10,000 divide, no, 1,000. I'm doing salvage cost. 1,000 divided by the cost, which is 10,000. Okay. All that into brackets, raised to, into brackets, 1 over 10, 1 over the lifetime now. So you can see what we get. We get 0.20 blah blah blah. So, and then to now get the depreciation, we multiply by the period, which is now going to be times 1,000 times 10,000. So I can just go ahead and say, and this stretch is equals to I1 multiplied by 10,000 to get to 2056 point 718. So because of rounding off, that's why we get this value, but you can see the value is almost the same. So what we just did is round off the 56. We rounded off the 5 to 6. That's why we're getting 20.6. So I hope that becomes clear. So let us do for the second period where we are here. Let us do for the second period just to drive that point home. So we will do is equals to 1 minus salvage cost. So our salvage, I mean not salvage cost, but just salvage. Our salvage is, let me just, sorry, let me just to remove that cursor there. So our salvage is 1,000 divided by the 10,000. Okay. Um, raised to raised to 1 over 10. Wait. Have I done that? Oh, no, 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 no. Sorry for that. We'll just be getting the same value. Okay. So with now, to get the second period, we will just go ahead and subtract 10,000 from this. So I'll just say is equals to 10,000 minus J1. Yeah, 10,000 minus J1. I don't know why it's not cooperating. Put it in brackets. 10,000 minus J1. Okay. And then we multiply by I1. I1. Like that. Yes, we get 163.7. Yeah, so that is now how we calculate the declining balance manually, but now with Excel it's just direct. Okay, so let us move on to DDB, which means double declining balance. So to get this, we just say is equals to DDB into, just, yeah, DDB into the cost, which is B1, comma the salvage life, which is B2, comma the life, which is B3, comma the value of the period, which is A1. So that is just DDB. Okay, there's something wrong. B, oh, A1, no, A8. A8, sorry, because we're getting this period. Okay, so we get 2000. Okay, so to just do the second one, is equals to DDB into B1, comma B2, comma B3, comma A9. So we get $1,600. So what is really happening with the DBB? So it takes the useful life, that is the 10 years, to get, so it first does 1/10 to get 0.1. So since this function is called double declining balance, we double this rate. So it's going to be factor is equal to 2. So the depreciation rate value for the first period will be 10,000 divided by 0.2, multiplied by 0.2. So what am I talking about? I'm saying we will have 1/10, that is the life, to get, okay, sorry, is equals to 1/10, which is going to be, okay, 1/10. I put it in brackets, see if that will stop making it giving me, okay, it's not. So 1/10, making it to be 0.1, right? So 0.1, since it's double declining balance, we multiply by 2. Multiply that by 2 to get 0.2. This is not cooperating at all. To get 0.2. And then now that's 0.2. You're now going to multiply it by 10,000. So when you multiply 0.2 by 10,000, you will now get the 2,000 that you have here. And then now you will come ahead and say, yeah, to get now for the second period is now going to be 10,000, 10,000 minus 2,000 multiplied by the 0.2, you will get 1,600 immediately. So you'll just continue doing that. Okay. Okay, so that is that. So I want to move on to the last one, that is the VDB, that is the variable declining balance. So the function uses the DBB method by default. So we will just go ahead and see how that becomes a little bit different from the declining, the double declining balance. So you say is equals to VDB, though it won't be that different from the double declining balance. It becomes different when you calculate all these values up to the end, up to the 10th value. That's when really you can see the difference, okay? So we will have our cost, which is B1, our salvage, which is B2, our life, which is B3, and now we are going to say our value in our period. So we are going to say A8 minus 1. Okay. And then we will now come ahead and say our end period is A8. To just calculate the value, the period before and the period after. So if you go to the second one, it will make a little bit sense. So the first one will now, of course, amount to 0. So if we do that, you see it comes to 2,000. Okay. So the VDB is performs the same as the DDB. It switches to straight line to make sure you reach the salvage value at the bottom. Now, when you get it to the probably roughly between the ninth period and the 10th period, and then so it switches to the straight line calculation when the depreciation value, um, that is the straight line, is higher than the depreciation value DDB. So this is something we can see if you just proceed doing that calculation, you will see it change between the ninth and the 10th value. So it's something I can only explain with the calculation, and I will link the Excel for that calculation just to save up on this time so that we can just see how that is done. And I will um I will see if I can add some explanation on that link so that you can just be able to understand that more. Okay, so we are done with depreciation. So I want us to move on to the final part of this, and that is the profit margin. The profit margin. So this is just going to be a little bit light, unlike the depreciation, though I don't think it was that hard, but that's just my opinion. So in profit margin is calculating the gross profit margin, operating profit margin, and the net profit margin. That's what you're going to be doing, calculating the gross, operating, and the net. So we're going to start with the gross profit margin. So assume your business has a total revenue of 10,000. So I'm just going to probably write here total, okay, total revenue. So just increase this. And we will have cost of goods sold. So I can just write that in summary as cost of goods sold. So we will have the total revenue of $10,000 and the cost of goods sold of $4,000. Okay. So to calculate the gross margin, we use the formula of total revenue minus the cost of goods sold divided by total revenue. So how do we go ahead and do that? We will just come ahead and write, so here to just write the gross gross profit margin. So let me just increase the width. Is going to be is equals to, so remember it's total revenue minus cost of goods divided by total revenue. I think that's a formula that you are all used to by now. So it's going to be B1 minus B2 divided by B1. Okay, so we get 0.6. So that's the gross profit margin. If you decide you want to apply it as a percentage, just click on it there and you go to there should be a formula here that allows me, I think it should be on the home page, home Yeah, here it is. So you can see it goes directly into 60%. So that's the gross profit margin. So let us calculate the operating profit margin. So to calculate the operating profit margin, we will have our total revenue. Let me just zoom in just in case. Yeah. So we just have still our total revenue, and then we'll have the cost of goods sold, and then we'll have the gross profit margin. Yeah, so let me just add more to that. Yeah, so we'll still have the same amount of $10, $10,000, and then 4,000. Yeah, so oh no, no, I just rewrote. We want to find the operating profit margin. So to have the operating profit margin, you're going to be excluding operating expenses. So here we should have something OPEX, meaning operating expenses such as rent, equipment, inventory, marketing, something like that. So we have this as 1,000. Okay, so to calculate the operating profit margin, profit. To calculate the operating profit, we will have total revenue minus cost of goods sold minus the operating expenses over the total revenue. So we'll now just go ahead and do that. So I'll come ahead and say is equals to total revenue being G1 minus G2 minus G3, yeah, divided by G1. Okay, so you can see that is 0.5. So I can just make it into percentage. That is 50%. 50%. So we can now move on to the net profit margin. So you can see these are things which are very helpful when you're doing your business, or you just want to know, okay, so what am I really working with, right? So let us now move on and have the net profit margin. So this also includes non-operating expenses such as interest on debt, taxes, and that. Okay. So to do that, we're just going to do total revenue, total revenue. Okay. Cost of goods sold, operating expenses, and then interest and taxes. So if I just do that, yeah. So just have 10,000. Cost of goods sold is 4,000. Operating expenses is 1,000. And then our interest is 500, and then our taxes are 1,000. Okay, so we now want to calculate the net profit margin. So to do that, just increase that width. We are going to So the net profit margin is going to be total revenue minus cost of goods minus operating expenses minus interest minus taxes over the total revenue. So to just move ahead and do that, it shall be, in our case now, total revenue, which is K1, oh no, I should put on is equals K1, right? Minus, so I can just take, to shorten this, I can just say minus sum of, from the from the cost of goods sold up to the taxes, okay? So I can just say from K2 up to K5, okay? Up to K5. Um, yeah. So what I should have done is I should have put all that into brackets so that I can be able to divide by the total revenue. Into brackets, yeah. So all that divided by the total revenue, which is K1. So do that in percentage, becomes 35%. So, and that is now our net profit margin. So this net profit margin. So yeah, so that concludes the end of our Excel with finance. I hope you've been able to learn a lot. Just apply it as much, and yeah. So I will definitely share the whole table for the depreciation so you can just see how that looks like at the end of each period and of the 10th value. So remember, in the depreciation, this is the depreciation value. This is the depreciation value. So you can, if you want to go ahead, let me, I think I forgot to add this. If you want now to add the asset value, you will now, let's say for the S, for this, for the straight line function, we are now going to type, yeah, that, just type SLN, and then now the period, the first one will be 0 for this case, so it will be automatically 10,000. And then now for the first period, it's now going to be 10,000 minus the 900, which will be 9100. So I will do that, and I will, so when I send the data, it will have both the depreciation up to the 10th year and then the asset up to the 10th year, so that you can just see the asset value concluding to 1,000. Other than that, I've had a nice time. So yes, bye bye.